Everybody focuses on the interest rate, the wrong thing, and this is the mess we're in. This is why we've had this yo-yo type of activity. You know, we had inflation, now contraction, and ultimately a recession as a result of that. Everybody focuses on the interest rate, the wrong thing, and
You're watching CapitalCosm. My name is Danny. It is August 22nd, 2025, and my guest today is none other than Steve Hanke. Steve, thank you so much for coming back on the show, my friend.
good to be with you, Danny.
Yeah, let's just dive right in. It is Friday, August 22nd, as I mentioned at the start of the podcast, and we have this big announcement from Powell. This is from CNBC, and it says that they will be, so here's the article. Powell indicates conditions may warrant interest rate cuts as Fed proceeds carefully, quote unquote. What do you make of this, Professor Hanke? I know you and I have talked about interest rates and their true effectiveness on bringing down inflation or, creating the mechanisms for impacting inflation and deflation. But what's your view on this announcement as it comes out today?
Well, my view is actually summarized pretty well by a Fortune magazine article that John Greenwood and I wrote that came out yesterday before the meeting. And the title is Monetary Policy is Not About Interest Rates, It's About the Money Supply. So all these central bankers, including Powell, and by the way, including Trump, they all talk about the interest rate that the Fed controls, which is the overnight interest rate called the Fed funds rate. The central bank does control that. And Trump has made the argument that a monetary policy is too tight, and therefore the interest rate, the Fed funds rate, should be lowered to loosen up things. And he wants it. He's right. He wants them to lower it by 3 percentage points. Now, the problem with that, on the one hand, the monetary policy is too tight if, in fact, you look at the right indicator. The right indicator is the growth rate in the money supply measured. The Fed's broad measure is M2, and that's growing at 4.5% per year. It's not growing at a rate that's consistent with hitting the Fed's inflation target of 2%. That would be that's Hanke's golden growth rate. That's about 6%. So what's happened is that the stock of money actually declined, as you can see in your chart there. It contracted, and then it started growing, and now it's up a little bit higher than it was in April of 2022. So what we have is a situation where you've got the president quibbling over the interest rate, the Fed funds rate, with Powell, the chairman of the Federal Reserve, who he's also looking at the interest rate. So they're both looking at the wrong thing. That's the start. That's the starting point. It's not the interest rate, it's a money supply that you have to look at. And what's going on with the money supply? The money supply actually, as you can see in that chart, we had this big contraction. Now the contraction will eventually lead to a slowdown in the economy, and it's slowing down right now. We've only had 4 contractions like that since the Fed was founded in 1913. And each one of those led to a recession. Actually, one led to the Great Depression. In 1929, 1933, we had a 37% contraction in the stock of money. And of course, we had the Great Depression. And we also had at the same time the Smoot-Hawley tariffs come in. The average effective tariff rate on the Smoot-Hawley tariff was 19.7%. Now, Trump's tariffs, if they went in as now advertised, they would be 18.2%. So the highest tariffs we've had since the 1930s, and almost the same level of tariffs, which were, of course, an additional factor that pushed us deeper into the depression, and the depression lasted for longer than would have otherwise been the case if we hadn't had those tariffs. So that at 30,000 feet, very quickly, that's what's going on. They're looking at the wrong thing. They're looking at current data. And the current data, everyone is data dependent. All the market people are data dependent. Most people are data dependent. And the reason they are is because the models, the macro models that we've had, these neo-Keynesian macro models we've had for the last 30 years, they don't include money. They include the interest rate, but they don't include money. So everybody's been trained with these models. Everybody focuses on the interest rate, the wrong thing. And this is the mess we're in. This is why we've had this yo-yo type of activity. You know, we had inflation, now contraction, and ultimately a recession as a result of that. So that's my general take is the following, and simple, to keep it simple. I anticipated with John Greenwood when we wrote this article that was published yesterday that is exactly what they'd be talking about. The only thing they'd be focused on would be the Fed funds rate. And everyone is focused on the Fed funds rate. And everyone is actually wrong, because monetary policy is not about interest rates. It's about the changes in the money supply. And I can give you some examples that we used, John and I, in our Fortune article that are pretty revealing, because they're big episodes, big things where everybody got it wrong, except the monetarist like Greenwood and myself, or Matt Sakurki, who co-authored a recent book, Making Money Work, which lays out the whole thing. Actually, the Making Money Work book came out on May 6th, and that's got it all in there. But let's look at three examples, big examples. Let's look at the lost decades in Japan from 1996 to 2019, and what happened. The average bank interest rate from the Bank of Japan, the equivalent of the Fed funds rate in the United States, the bank rate was 0.1%.
Mm-hmm.
It was almost zero, the average, over that whole span of time. And as a result of that, everybody said, and they still say, Japan has easy money. Easy money. The reality is the M2 growth over that whole period of time, 1996 to 2019, was only 2.8% per year. And that means what? It was way below Hanke's golden growth rate, and the money supply was tight. It wasn't easy. If you looked at interest rates, you'd say it was easy. If you looked at the money supply, you'd say, oh, Japan was very tight. Well, what was the reality? The reality is Japan didn't grow, and its inflation averaged over the whole period, 1996 to 2019, 0.2% per year on average. It was almost zero. They almost had no zero. So you had the lost decades, and the lost decades were due to extremely tight money and the fact that everyone that was looking at interest rates just had the thing wrong. The Bank of Japan thought it was loose with the bank interest rate set by the Bank of Japan at 0.1%, almost zero. So that's one case that indicates monetary policy is not about interest rates. It's about the money supply, which, by the way, neither Powell nor Trump are talking about. They're fighting about one thing, the interest rate. They're focused on the wrong thing. They've got it all wrong.
Right.
Let's look at the second example that's particularly relevant for your listeners, and that's the great financial crisis. And after the great financial crisis, if we look at the period 2010 to 2019, what happened then? The Fed funds rate went down to 0.25%. It almost went to zero and was held there. And also, there were three episodes of quantitative easing in that period, 2010 to 2019. And most observers, and especially a lot of hard money people, by the way, said, oh, they have tremendous easy monetary policy. The Fed's balance sheet's exploding with all this quantitative easing. The Fed funds rate's at 0.25%. And a lot of gold bugs actually said we were going to have hyperinflation, which was a ridiculous thing. They were looking at the wrong data, because actually what happened is that the money supply grew at 5.8% in that period, 2010 to 2019. Now that's almost exactly what Hanke's golden growth rate is for the Fed, so that can hit its 2% inflation target. That my golden growth rate 6%. The average in that period of time was 5.8%. And what was inflation? Just what I would think it would be. It was 1.8% at average, almost right on 2%. A little below, but the growth rate in the money supply was a little below Hanke's golden growth rate of 6%. It was 5.8. So that's the second big episode. And as I say, particularly relevant for people trading commodities and so forth, because most of them were looking at the interest rate and the quantitative easing and the explosion and the size of the Fed's balance sheet, and they just got it all wrong. They should have been looking at the money supply, and they would have seen it was growing at just about where it should be growing, at about 5.8. Now, let's go to the third episode, which is interesting, and that's the COVID, the post-pandemic episode. So let's look at 2020 to 2024. And sure enough, the lockdowns occurred in February, and the Fed lowered its Fed funds rate to 0.25%. Just what they did in the great financial crisis. So they did that, and they also started engaging in quantitative easing. So everybody then thought, they switched gears and they said, oh, there's going to be no inflation, because the last time the Fed did that, the last time after the great financial crisis, when they lowered the Fed funds rate to 0.25% and engaged in quantitative easing, there was no inflation. They almost hit that. So that was their conclusion. The problem was, if you looked at the money supply, things were a disaster. Actually, the growth rate average in that period of time for the money supply, 2020 to 2024, was 17.3% per year. Actually, between March 2020 and March 2022, the average was right up at the all-time high, huge growth. And what did we end up with? June 2022, inflation, 9.1%. Using the quantity theory of money and focusing on the money supply, Greenwood and I, where did we say it was going to go? We said it was going to go to 9%. Well, it went to 9.1%. And the average, by the way, over this period from April 2021 to December 2022, the average inflation is 7%. So things weren't normal after the pandemic. We had an explosion in the money supply. If you were looking at that and paying attention to that, you would have concluded exactly what Greenwood and I concluded, that we were going to have a lot of inflation, and we did. Everybody else was looking in the rearview mirror, and they said, oh, the Fed in the pandemic is doing exactly what they did in the great financial crisis, and we never got any inflation, so we're not going to get any inflation now. Or many people said, oh, it's team temporary. Remember, it was going to come and go in a hurry and not be a problem. It was just a supply chain glitch and a little pop in the oil price. All these ad hoc reasons that were given to rationalize the whole thing and get the whole thing wrong, by the way. So the takeaway is a pretty simple takeaway. Everyone is looking at the wrong thing. They're focusing and obsessing about the Fed funds rate and interest rates and not the money supply. And by the way, changes in the money supply affect ultimately inflation and ultimately yields on bonds, especially like the 10-year bond, not the Fed funds rate, but the 10-year bond. And that is something people should be obviously paying attention to. But that's a symptom only, those long-term interest rates, of what's been happening to the money supply before. If you look at the data today on the 10-year, the 10-year, roughly where it hovers around, is largely influenced by what was happening to the money supply a couple of years ago.
Yeah, let me pull that up here really quick to look at. But in the meantime, you also have a conclusion here, and it basically tells us that money supply is fundamental, like you said. Interest rates are just responding to the phenomenon that is fundamental, and that is money supply. Is that the correct way of viewing it?
Yes, it is, because what happens, and this it becomes tricky, but there's kind of a two-step process. Let us say that we get a reduction in the Fed funds rate. What happens, the interest rates initially go down. You look at a chart today and the interest rates have gone down. All the interest rates are along the yield curve. The whole thing has gone down. Right. After the speech, because they anticipate that the Fed funds rate is going to be lowered. So the first step is, the Fed funds rate lowering, or the anticipation of a lowering in the Fed funds rate, puts interest rates down. But then after things start loosening up, we eventually get more inflation and the interest rates start going up. So there's a two-step process. The first phase of a Fed funds rate is one way, but the sustained level that comes into play later on is exactly the opposite. So if you increase interest rates, for example, and the initial step is, interest rates increase with the Fed funds rate. But then tightening starts to occur and inflation becomes weaker, and yields then on bonds become weaker. The price of the bonds go up and the yield goes down. So that's why many people, including the markets, get very confused about this, because they aren't looking at the money supply, and they don't realize that the interest rates, actually, the sustained level of interest rates always follows what happened to the money supply a couple of years prior to the time you're looking at the data.
Hey guys, quick pause from the podcast, but this is something I feel is really important to let you in on. Back in 2020, before I even started this channel, I was looking for an edge, a way to find the big opportunities most investors never even hear about. That's when I found Capitalist Exploits Insider. From day one, it felt like I suddenly had my own team of world-class market pros working for me, digging up trades all over the world, doing the deep research, and handing me ideas that had massive asymmetric upside. Stuff that I would never even think about. Since then, my gains with them have blown past the S&P and the NASDAQ, and it's honestly the single best newsletter I've ever subscribed to. And that's not me blowing smoke. That's for real. I've interviewed their publisher, Chris McIntosh, more times than I can count. In fact, my latest conversation with him is linked in the description box down below if you want to check that out, as well as the pinned comment. And every time, I'm reminded why I've stayed a member for years. Right now, they're offering a special $1,000 discount on the Insider subscription, but it's only for CapitalCosm viewers, so you're only going to get it by clicking the link down below in the description box or the pinned comment. You're not going to find this anywhere else. Click the link, lock it in, and start getting the same game-changing research I've been using since 2020. Yeah. So this is what we've got here on the screen. We've got the M2 money supply at the top. We've got the 10-year yield right below it. This is the orange line. Right below that, we have the CPI. And then right below that, at the very bottom, you've got the Fed funds rate. And money supply leads all. You see the big spike here in 2020. And you didn't really start to see it manifest in CPI up until, see this big jump here from early 2020. You didn't see the CPI really manifest itself until much later on in the year, like you said. And then you've got the 10-year yield here as well. And of course, that was late to the party too. You bottomed at around the same time. It bottomed around the same time when M2 money supply had already had its big first leg up in growth in from March of 2020 all the way out until June of 2020. That was the first leg. Interest rates on the 10-year were still at the near bottom here back then. And of course, the Fed funds rate didn't move at all up until May of 2022. So
right. So these charts, this is excellent. What you have really tells the whole story in these graphs. Now let me just you explain what the graphs show. Okay, you got, and you're right, and the graphs are right. The data speak pretty loudly. And what this means is that if you go back to the quantity theory of money, and if you look, for example, at the books that Kirky and I have just published, Making Money Work, you'll see that if you have a significant change in the money supply, like your top graph line there, you will get in first you'll get an increase in asset prices. That happens immediately, almost. Within about 3 to 6 months, asset prices start changing. So the stock market went up, rents, land prices went up, housing prices went up, all asset prices went up. And then with a little longer lag, the economy starts picking up. And then with a lag of usually between 12 and 24 months, inflation picks up. And that's exactly what happened. You can see on the graph. And then following that, you get yields on bonds like the 10-year start going up. So the sequence is this, and this is why people get confused, and it's hard for them to understand what's going on. They're looking at today's data. They're all data dependent, and they don't have any model of anything in their head. They basically have their finger in the wind, and they're just looking at the computer to see what all the recent releases are and things like that. Mm-hmm. But they don't realize that all the recent releases are driven by what was changing in the money supply a long time ago. You've got to get your head around what's going on with the money supply prior to the time that you're actually looking at the data, because the data are just symptoms of what was going on in the money supply.
And you can see this clearly. So now I've isolated it to just the M2 money supply at the top and the Fed funds rate at the bottom. And you can clearly see the lag, the pattern between the two. You had this big hump here in M2 money supply, and now you have this big hump in the Fed funds rate, but albeit 2 years later. And even the drawdown in M2 money supply that we saw from May 2022 down to the bottom here the bottom of the correction down to July of 2023, we're just now getting to the bottom of that in terms of Fed funds rate. So does this portend to, I mean, not that it matters because M2 money supply is fundamental, but does this mean that they will eventually hike rates back up given the fact that this M2 money supply chart is pointing back up again?
Well, not necessarily, because remember that all those other graphs that you gave are market determined, except the money supply. The money supply in a way, the money supply is market determined in the sense that most of that M2, about 80% of the M2 is actually produced by commercial banks privately. But the Fed funds rate is a controlled rate by the Fed.
Mm-hmm.
The Fed dictates that. That is not a market rate. It's the 10-year that the 10-year would be the one that you'd really want to be looking at.
And this is it right here.
Yeah. Okay. Fine. So you can see the money supply gets goosed, and sure enough, we end up with inflation. If you had inflation in there, inflation would pick up, and then the yield on the 10-year would be going up.
Yep. This is inflation here at the bottom.
So the following steps are very important to get your head around, and that is big changes in the money supply cause big changes in asset prices. That's the next thing that happens. And then the next thing that happens, the economy, the real economy, economic activity starts changing. And then the last thing that comes in is the inflation. And then after that, actually the last thing then that follows that, yields on long-term bonds. So that's the sequence. And the trick is there's a real art to this because these lags are long and variable. They aren't the same. Each cycle, and depending on what's going on and so forth, can mean that it's not a mechanical thing, Danny, where you say, oh, in 12 months after the big change in the money supply, you will get a change in inflation. No, it might be 24 months, not 12 months. So to put your finger exactly on where things are going to occur after the key causality of the money supply comes in is tricky.
Is that dependent on money velocity? If money velocity is higher, okay.
The money velocity is essentially, this is another bugaboo. The money velocity is pretty constant. The rate of change is negative 1.7% per year in the United States. Occasionally you'll get deviations from it, but all the deviations come out in the wash because once you deviate, things revert back to the mean. They revert back to 1.7. So that's another thing that has to be factored in, but it's more of a bugaboo than anything else because most people poo-poo monetary economics and the quantity theory of money because they say, well, if you have MV, money times velocity equals PY, that's the equation of exchange, where P is the price level and the Y is real economic activity, and M, of course, is the money supply, and V is velocity. They say, well, since V fluctuates all over the place, so you really can't use that equation of exchange for anything useful. That's BS. We used it pretty usefully. We indicated that Greenwood and I that inflation would go up to 9%. It went up to 9.1%. So that's the end of that story. And we indicated also that on the downward trend that's occurred after, see the contraction where that contraction starts in the money supply right there, that graph that you have. Using the quantity theory of money and looking at the contraction, we indicated what the path of inflation would be as a result of that contraction in the money supply, and we got that right too. So the point is interest rates are what they are, but the Fed and their market determined, with the exception of the Fed funds rate, and everybody looks at the one rate that's not determined by the market, determined by the Fed, obsessed about that, thinking that indicates where monetary policy is, where it's loose, tight, neutral, and so forth. No, I went through those three cases to show you that every single time you focus on the interest rate and these big episodes that I went through, the Japanese lost decades. The post great financial crisis in the United States and the post pandemic in the United States, you'd get it all wrong. To get it right, you have to look at the money supply.
Right. And with all this in view, with this model in view, what does that lead us to? What do you kind of project ahead as we kind of hurdle forward?
Well, one thing is that the economy is slowing down and probably go into a recession later. Well, within the next 12 months, we'll probably see a recession pop up. Now, aggravating that, of course, we have the monetary effect, and that indicates that we should expect a slowdown in the economy and maybe a recession. But then you've got Trump's tariffs on top of it. That's like the Smoot-Hawley tariffs that I was talking about in the 1930s, and that's going to aggravate the situation. That's not going to help. It makes it worse. It increases the probability that we'll have a recession. So that's the picture in the real economy. The picture on inflation is a little bit tricky, but it's the general level of prices will continue to go down. However, there will be changes in the relative prices, with obviously imports going up because of these tariffs. So the general level, the big aggregate consumer price index, that kind of thing, the forces of the money supply will be pushing it down, down, down. However, you might get a blip, a temporary blip, due to the imposition of tariffs, because they will affect import prices and distort the picture a little bit. But even if you get a temporary blip up, which we haven't had yet, that will be temporary.
Fascinating. What does that imply for gold prices then? Does gold tie into the? I mean, I'm sure it does, but how does gold tie into the monetary theory of money?
Well, first of all, gold ties into the monetary picture because right now, if you look at the market today, what's happened? They think interest rates, the Fed funds rate's going down, and they think interest rates are going down. So the initial reaction is the dollar gets weaker and gold gets a lot stronger. I mean, gold's way up, and interest rates are down. Dollar is weaker, gold is up. So that's the initial kind of knee-jerk reaction. We literally have it live, right? As we speak about this, Danny, we're not in a classroom. We can look at what's going on in real time.
Right.
I mean, let's just look at this thing now for 1 second. Again, expectation that the Fed funds rate is going to go down because of Powell's speech in Jackson Hole, Wyoming. And right away, the dollar gets weaker. Right away, initial reaction, gold follows it exactly. Gold's up almost $40 an ounce. It's at $34.2150 right now. So if you had the charts, it's just Powell gives a speech and bingo, the dollar gets weaker and gold gets stronger.
Yeah, here's the daily chart. We have a big green candlestick today. If you want, we can look at it from a more. There it is. So this is from an hourly candlestick.
Yeah.
Here's the candlestick where he made his announcement, and boom, goes off to the races.
Yeah.
From 33.76 to 34.21. So
look
40 plus.
Look at the dollar. Look at the dollar euro. Okay. That's actually the most important price in the world is the dollar euro exchange rate. So
yes. So here's the DXY. Isn't that pretty much a proxy for the dollar euro?
Yeah, right.
Yeah. So boom, there it is.
So at any rate, that's the initial thing. But the expectation is let's go longer term. My two-step process. My two-step process is what? Probably inflation will get aggravated if they loosen up eventually. I'm not talking about the short term, which I was talking about a little bit earlier when they talked about inflation. But if you look a little longer, that implies that we'll have more inflation, and of course that's good for gold. That keeps the bull going. The bull's going to keep roaring with gold.
Understood.
It's been more or less consolidating recently, but I think it's going to take off pretty soon. And that's for a couple of reasons. One is this inflation thing, but gold usually does well going into a recession.
I see. And is that the case with silver as well, or no?
Honestly, I mentioned this before. I honestly, I just don't follow silver.
Gotcha.
I,
Well, all right, Steve.
well,
I mean,
I shouldn't say that. Yeah, I follow it. I see the price and so forth, but analytically, I don't follow it. I'm not trading it, so I'm not spending time with a sharp pencil fooling around or looking at candlesticks or anything like that.
Right. That's my job. So,
Yeah.
Steve, thank you so much for coming on the show, my friend. Anything else you want to get into before we sign off?
Well, the only thing I would say is that the Fed now, there's a lot of talk about reconfiguring the Fed and changing its modus operandi and so forth. I mean, Trump has ideas, even Powell has ideas, and the blueprint for doing that properly is the book Sakurki and I wrote, Making Money Work, which easy to get. It's all on Amazon and online. You can get it. Wiley released it May 6th. So that's where the blueprint is. If you really want to get your head around monetary policy and what is happening now and what should be happening, that's the place to go.
All right. We'll link the book down below in the description box, so be on the lookout for it, guys. Steve, where can people find you if they want to see more of your work aside from the book? What's your Twitter handle?
Yeah, Twitter handles at Steve_Hanke, and got about 806,000 followers. I think it's rated by Focus Economics in Barcelona as the third most influential economist in the world. So,
well, we'll try.
Got a good following, and I do put up things related to what we're talking about right now. This keeping your eye on the money supply. And
yeah, we'll try our best to get you over that million hurdle.
Oh,
but,
that'd be great.
No guarantees though, but we'll do our best.
Yeah, that's a good objective. That actually is kind of my target.
Mm-hmm. Yeah. By end of year, do you think, or like what's your time frame?
It depends. It's conceivable, but it's very hard to predict, honestly, because it can kind of flatline for a long time and then boom, all of a sudden jump.
Yeah.
It depends on what you're putting up, and it's very country specific, by the way. So if you put up something on a country, you can pick up a lot of followers if they're I'm putting up something that's grabs them and is interesting. It's like anything else. It's like you're selling something, and if the consumer is satisfied, you tend to pick up consumers. If they're not excited about what you're putting out or don't find it to be of value, you flatline.
Yeah. Well, Steve, it's been a pleasure having you on, my friend. We'll link to your socials and your book down below, so check it out if you're interested, guys. If you got value out of this podcast, drop us a like and comment, Go Steve Go, in the comments section. If you agreed or disagreed, do let me know your thoughts. I do, in fact, read the comments, and I will be replying to a handful of these comments. So drop me your thoughts down below. Very interested in seeing what you guys have to say here. And then subscribe to the channel so you don't miss an episode, and liking, subscribing, commenting, doing all the YouTube stuff. It does indeed go a long way in helping push this channel and this video in the algorithm. So if you'd like to message out to as many people as possible and to support the channel, that's an easy way to do it. So And also check us out on Substack at capitalcosm.substack.com to get early access, ad-free versions, and uncensored versions of all of my stuff. So with all that said, thanks for watching, guys, and I will catch you later. Bye.
Thanks a lot, Danny.